Okay, let's understand what are the four possible option positions and what can you do to take advantage of a bullish market or to take advantage of a bearish market by dealing into derivatives. Let me tell you at this point in time, friends, dealing in derivatives is fraught with risk. You really need to have a very good understanding before you start dealing in the derivatives. And we are in the process of gaining good understanding about the derivatives and valuations so that we are able to use this knowledge in the context of implementation of ESOP schemes in our respective companies. So if you are bullish, if your view about the market is bullish, what you can do, you can buy a call because you are expecting that the market prices, stock prices are going to go up. So you can buy a call. So when you buy a call at today's exercise price, and by the time your exercise date comes or expiry date come, the stock price would have increased. So you will have the benefit of the difference between the then market price and the exercise price. Or you can write a put. So if you are expecting the market to go up or stock prices to go up, you can write a put. So when you write a put, that means what? That means you are selling to someone a right whereby you are taking an obligation to purchase shares from that person to whom you are selling a put option at the exercise price. Right? So since you are giving him a right to buy from him. So remember, when you are writing a put, that means you are giving a right to the buyer of the put option that you will purchase a certain share of a company at an exercise price. Now, since you are writing a put, and remember, the person who is buying a put option, what he is expecting the market to go down, and you are expecting market to go up. So that is why you are writing a put option. Now, as it would happen, if your reading goes right, you are bullish about the market, you have written a put option, but contrary to it, the stock prices have gone down. So that means you will stand to gain. If you are bearish, then you should buy a put option because you are expecting the market to go down. So you buy a put option. What the put option will give you? Put option will give you a right to sell your shares at an exercise price, which is, let's say, of today, whereas you are expecting this price to go down in future. And the seller of the put option to you is taking an obligation to purchase from you these shares at the exercise price. So as you expect the market to go down and you have purchased a put option, the market really goes down and you are able to sell the shares at the exercise price, the current exercise price, which is much higher than the market price in future. So you can do buy a put option, or you can, if you are bearish, you can write a call option. So these are the strategies that you can deploy for taking benefit of the capital market or the finance market. So what is the profit potential and the loss potential? Let's review it. So if you are buying a call option, remember your profit potential is unlimited and your loss potential is limited only to the amount of premium you have paid. So you have bought a call option, the prices have gone up, so the difference in the spot price and your exercise price is going to be your gain, and that can be unlimited. But if the prices go down, which can also happen, in that case you will just not exercise the option, and as a result of that, your maximum loss is going to be the amount of premium that you would pay. You are writing a put option. So what is the profit potential? So if you are writing a put option, so your profit potential is limited to the amount of premium that you receive. So remember, the writer of the option, whether a put option or the call option, he only earns the premium that he receives, but he takes the risk which is unlimited, which is open. So अगर आपने put option लिखा है, if you are writing a put option, the profit potential that you have is only the premium, and your loss is unlimited. Your loss is unlimited. That means because you have written a put option, that means you have undertaken taken an obligation to purchase shares from someone at an X price, exercise price. So if that price of that stock goes down, remember, so the lower the price goes down, higher is going to be your loss, because you will have to purchase those shares from that person at the exercise price of the put option. So your okay, now if you are bearish, then what you can do, you can buy a put option. So if you buy a put option, your profit potential is unlimited, and your loss potential is limited only to the extent of premium. Or you can write a call option. So if you are writing a call option, your profit potential is limited and your loss potential is unlimited. So remember, when you say unlimited, it would mean limited to the difference between the strike price and the spot price, because spot price cannot go below zero, and that is why it is said limited to the extent of the stock price going down. What is